In this video, I'm going to do my best to unpack for you what happened to Silicon Valley Bank last Friday as it imploded and sent shockwaves through the financial markets. America's 16th largest bank had some $175 billion in deposits, which disappeared and evaporated by breakfast. It wouldn't have happened if not for management mistakes, as I will lay them out to you. This was a 21st century bank run where customers in a panic tried to withdraw about $42 billion, a quarter of all deposits. But what triggered the collapse? Let's take a look. Back in January 2020, SVB had $55 billion in customer deposits on its balance sheet. By the end of 2022, that number had exploded to $186 billion. Yes, SVB was a victim of its own success. These deposits were often from initial public offerings and special purpose acquisition company deals. A SPAC is a publicly traded corporation with a 2-year lifespan formed with the sole purpose of effecting a merger or combination with a privately held business to enable it to go public. SPACs raise money largely from public equity investors and have the potential to de-risk and shorten the IPO process for their target companies, often offering them better terms than a traditional IPO would. SVB banked almost half of all IPO proceeds in the last 2 years. Most startups had relationships with the bank. That's a lot of money, folks, to put to work. Now, some of it was lent out, but with soaring stock prices and near zero interest rates, no one was looking to take on excessive debt. There was no way SVB was going to initiate $131 billion in new loans into the market. So the bank put some of this new capital into higher yielding long-term government bonds and $80 billion into 10-year mortgage-backed securities paying 1.5% instead of short-term treasuries, which were only paying 0.25%. Let's call this F-up number one. SVB went for yield instead of liquidity, which for those of you around in the 2000s is just what Bear Stearns and Lehman Brothers did. So with few loans, these investments were the bank's only profit center. SVB got caught with its pants down as interest rates went up and as the value of those investments concurrently dropped. Everyone, even the homeless in San Francisco, knew interest rates were heading upwards, which appears to have been a news flash to SVB management. The Federal Reserve Chairman, Jerome Powell, had been repeating this over and over again. Yet SVB did nothing and went on as business as usual, borrowing short-term from depositors and lending long-term without any interest rate hedging for protection. The bear came out of hibernation back in January 2022 as things began to change 14 months ago. Now, these are experts, folks. Seems a little unbelievable that it took more than a year for management at SVB to figure out that credit would tighten and the IPO market would dry up, or that companies, their customers in a slowing economy, would still need to spend money on salaries and cloud services. Put another way, SVB misread its customers' cash needs, and this was F-up number two. Risk management seemed to be an afterthought. The bank didn't even have a chief risk officer for 8 months last year, and the head of financial risk management and model risk Silicon Valley UK Ltd, Jay Ursap, self-identifies as a queer person of color and a first-generation immigrant from a working-class background. In Jay's bio, Jay says, "I feel privileged to co-chair the LGBTQ plus ERG and help spread awareness of lived queer experiences, partner with charitable organizations, and above all, create a sense of community for our LGBTQ plus employees and allies. I guess Risk is only real if you accept it is, right, Jay? As customers asked for their money back, SVB was forced to sell $21 billion in underwater longer-term assets with an average interest rate around 1.8%. The bank lost a whopping $1.8 billion on the sale and tried to raise more than $2 billion to fill that vast hole. The loss was like a Roman candle going off and alerting the market to the fact something was wrong at SVB. Venture capitalists, including Peter Thiel, suggested that companies in their portfolios should withdraw their money and put it somewhere safer. And late Thursday, all hell broke loose and there was no way to cover billions in withdrawal requests. Those much smarter than me have identified F-up number 3, which was not responding quickly by selling equity to cover losses. The first rule of survival is to keep selling equity until investors or depositors are no longer fearful and are not fearing imminent bankruptcy. Just think of the Bailey Savings and Loan from the movie It's a Wonderful Life and the scene where George Bailey has to keep the doors open when there's a run on the bank by doling out the money to deposit holders. His wife gives him the cash they were planning on saving for their honeymoon, and this lasts until the end of the day, finally calming the masses. In this case, apparently private equity firm General Atlantic made an offer to buy $500 million of the bank's common stock, which reportedly didn't go anywhere. Only time will tell if there was any last-minute investor Friday morning who might have offered up a few billion for half the company. There's certainly a few of those around, always hunting for deals. However, before they could get a deal together, the Federal Deposit Insurance Corp took over. With respect to this, I'll remind you of what Ronald Reagan famously said. The 7 most scary words in the English language are, "I'm from government and here to help," which is even truer given who's in charge of government these days. And last but not least is F-up number 4, which should serve as a warning to all CEOs of companies in trouble. Last Thursday, CEO Mr. Becker told everyone to stay calm. Yeah, that always works, especially when you're dealing with potential financial ruin for folks. So, at the end of the day, is SVB a regulatory failure? Maybe, given by all accounts that SVB was regulated like a bank, but appeared to have been doing business more like a money market fund. But then again, could this be a possible factor? In its proxy statement, SVB notes that besides 91% of their board being independent and 45% women, they also have 1 Black, 1 LGBTQ+, and 2 veterans. Now, I'm not saying 12 white men would have avoided this mess, but the company certainly seems to be more focused on diversity than diversifying risk. In short, leadership royally screwed up. Interest rates, underestimated customer withdrawals, hired the wrong people, and failed to sell equity. When it comes to handling other people's money, you may bounce back from a single mistake and be forgiven for it. But mistakes, plural, well, that's fatal. Which leads us to the final question. Were the F-ups as a result of an arrogant management team, a deluded one, or just an old-fashioned incompetent one? U.S. taxpayers will want to know, given they're the ones that are going to be paying for this mess. Anyway, I thank you for watching. If you haven't seen any of my other videos, please check them out. You can also subscribe to my Rumble and my YouTube channel as well, or my locals. Please check out, like I said, those channels. I've got other stuff on there, and I will see you next time.